According to Almanac Stock Traders, September, like August, is one of the spookiest months for stock. I always thought it was May, but hey, who am I to argue with people who compile almanacs? Over the past quarter century, August has tended to be the worst month for the Dow and the S&P 500, while September has been for the past half century. This is the MoneyMakers. I'm confused, and I'm Bruce Whitfield, because I've got not one, but two technical analysts in studio. Fasten your seatbelts, it's going to be a bumpy ride because I've got Moxima Gama, who's a technical analyst for the Money Hub, and Frans, Klerk, who's an independent technical analyst, to hear what the technical charts are saying and where we are headed. Frans, you know I'm going to ask you about hocus pocus and reading lines on graphs and how people make fun of technical analysts around the world. Just give me a position as to why we should take technical analysis seriously.
Remember, Bruce, there's always a misconception about technical analysts, and technical analysts only tell you what the chart is telling you. So in my job and in her job, we only follow the informed money. So what we do is we either use a line graph where you've got closing prices, where you make your decision on that, or like I use candlesticks, or she will maybe use bar charts. Now, those kind of things like candlesticks and even bar charts is nothing else to tell you what the informed money is thinking about the share or the index. So,
but it's telling us, isn't it, that what's happened in the past. It's not telling us what happens in the
not
future.
Really.
Or you become soothsayers of the past. You become historians and you learn what the past tells us about what the future will bring.
Well, I mean, we need to put in mind that it is pure sentiment, and that's what's been driving the market. I mean, if we had to look back and had to follow all the economic data that came out, and with the market still surging on that, it was sheer sentiment. So, I mean, you can make fun as you want, but when levels get bridged and bull trends are maintained, trend is your friend, and that's what that's the aspect of technology.
I'm not having fun. I'm simply trying to establish the credentials. So, Frans, give me a sense of where markets are at the moment, because what we've seen is a very steady rally. First quarter of this year, nice and strong for markets. Sell in May and go away. For the first time in years, actually held up to be true. But just before the all-share index on the JSE hit 54,000, and we've seen quite a sharp pullback in recent weeks in particular. The Chinese announced that they were devaluing their currency, and suddenly sentiment turned dramatically. You've got special names for what the lines look like on graphs. Where are we?
Bruce, the main thing that we must maybe just keep in mind that we've got a bull market now that's already 6 years on the go. Yeah. And this is what we call an irregular bull market. Usually a bull market lasts for about 4 years, and now we're on 6 years. And mainly this bull market was driven by what we call quantitative easing or stimulus. So what happened was when the bull market started, nobody could believe it. And the previous bear market didn't have the opportunity to play out. So what happened now, everybody got confused. We know that the Chinese messed up all their data, and so nobody can believe it. And on the other hand, the world was so flooded with, let's call it cheap money, that there was a few players in the market that pushed the market higher. So what we did was we followed the 200-day moving average. Now the 200-day moving average is a moving average that fundamental analysts are using, and as well as technical analysts. So that is the real long-term moving average. Now that went up all the way, and then suddenly the last 2-3 months something developed, and that was the 200-day moving average was tested and it turned into a resistance. But before that, we had a death cross, that where the 100-day moving average and the 50-day.
Hold on a second. Scholars of the Bible will tell you the death cross was on Golgotha. What is a death cross?
Okay, death cross means that if the 100-day moving average and the 50-day moving average crosses over, and that means that
sentiment is worsening.
That's exactly what she's saying. Then the sentiment is faltering, and that the momentum wants to turn around. And we didn't see it just on our index. We saw it on the Dow Jones, and we saw it also on the Hang Seng. So all of them came together and said, there's something happening. Although the market is going higher, the momentum or the sentiment was changing towards the negative.
Now, what is the death cross then, or she might tell you, about where markets are going?
Well, at present, like you had mentioned that there was a few that had formed, especially with the Russell 2000 as well, which really caused a bit of panic. But at this point, we wouldn't think you should panic, although there has been that crossover. But it's all logic, because it seems like investors are trying to be more, less risky. So they're getting away from risky stocks, so they're getting away from the small companies to get into ones that are more stable, like your Apples or your and you see Discovery.
The Disneys and the General Electric.
So it's like a way to soothe the pain
Yeah.
to get out. So it's not a death cross that should.
No, okay, but how do you
lead to
tell the
any-
difference between a death cross that's going to kill you and a death cross that might just like make you lose an arm?
No, there's a very important factor here is that while the market is below the 200-day moving average, remember that's the long-term moving average,
Yes.
then any rally, relief rally, that's developing below that average is only seen as a relief rally in a market that's starting to lose momentum.
Okay, so, and this is where you would bring in a term like a head and shoulders, for example, because the first part of this year was nice and strong. There was a sharp a sharp gain up to 54,000 on the all share, a sharp downturn, and then the all share got below 47,000. I know you prefer to use the top 40, but I've got all share in my head. But that sort of creates this shape of a graph of my broader shoulders, hopefully, but shoulders nevertheless. What does that then tell you about the state of markets?
Bruce, what was actually causing the, let's call the worry about the markets is that usually you find that in a top of a bull market, either a double top, and that means the index goes, let's say, to 50,000, it comes back to 47, goes back to 50, and it cannot go above that, and it turns around. That's a double top. So it's either a double top or a head and shoulder that causes the top of, that's calling a top of an index.
Because
so
we haven't seen a spike to 54 and back and 54 and back. So we haven't seen that double top.
we haven't got the
formation,
double top, but we've got a head and shoulder that played out to the bottom. And since, let's say, the top 40 index rallied from 42,000, we may be working on the right shoulder of a possible bigger head and shoulder that can break down below 42,000.
This sounds like a shampoo advert. I mean,
is.
head and shoulders. Okay, so don't panic. But it's hard to tell people not to panic, especially when the Dow has its worst month in 5 years. The Dow was off 5% in August. They call it awful August. And then September's supposed to be even worse.
Yeah, look, this is pretty much herd mentality. It's known over the couple of years that that's what the market does. So I think the market has been finding a reason to pull back. So in the short term, the sellers are now panning out, but it looks like the buyers are stepping back a little because, I mean, from last year, the market rallied on really thin or spineless information. So everyone found it very expensive, and this is, you need to, first of all, you need to kind of differentiate between a correction and a bear trend.
No, okay, so here's a great, so you talk to fundamental analysts and they will say to you, a correction is 10%, a bear market is 20%. And I say, well, how do you know that a correction doesn't become a bear? Oh, no, you don't. But that's where you guys come in.
When it breaches support, which I mean, if you know, as he was saying, that it could be the final shoulder. But the thing about I'm really wary about head and shoulders because they tend to pan out. Sometimes they don't. Like it could be the final shoulder, and then all of a sudden we have this rally.
And
but
then
what
you go
could
towards
help
what could become the double top.
Yes, but what could and then it breaks out of that, and it's now negated. But what could help is trend lines at this point.
But there's nothing to suggest fundamentally, and forgive me for going to fundamentals, that the market's going back to 54,000 or on the top 40 to previous highs. There's nothing to suggest it will, based on the fact that China is suddenly altering the rules of trading internally, going on witch hunts within China, tightening up on regulation on markets. It's basically removing liquidity from Chinese markets, which have been so crucial in driving the bull trend that has been on for the last 6 years.
There isn't, but you must realize that there still is a lot of buying capacity.
There's lots of money still
there's
swishing
still
around.
Lots of money, and somehow the big people will always try and create something to curb any sell-off, like how the Chinese did that regulatory thing of anyone who's got above 5%.
Sure, you're not allowed to trade for 6 months.
Yes, although it is kind of far off in terms of it's pretty much stealing from Peter to pay Paul, and it's a bit late because of the huge sell-off. But they will try and curb the market. And remember, we said that it was based on its sentiment, and once it reaches certain, this is what we've seen in technical analysis, that if it reaches a certain point, it has a tendency of stabilizing.
Right, so Frans, how do we know whether or not we're in this little pullback, which a lot of fundamental guys are getting very excited about? How do we know whether or not they are wrong on this?
The bottom line is that 200-day moving average of the top 40 index, and that is at 45780. So while
45780,
that's
why
the
is that number
important level,
important? Okay.
because at that point, when the index can consolidate for a week or two above that, suddenly all the technical analysts and the fundamental crew will be in one boat and say, okay, we've got maybe a new trend to the upside and everybody is positive. But unfortunately below that, and it is exactly as she said, below that level, suddenly some fundamental analysts will say, But why is the informed money starting to sell the index and it's starting to move below the long-term average that everybody uses? And because they do that, they look at the risk profile of the client and then they will reduce exposure. And it's actually simple because remember at 45,780, there was a buyer long time ago and there was a seller. And at that point, that's a pivot point below that.
Once the buyer disappears, then the buyer's got to be prepared to come in at another point. How do we know where that point is?
Bear trends are very temperamental and they're pretty much cumbersome to trade. But as Frans was saying, we should be careful that we seem to be agreeing a lot that it's a correction and not a bear trend yet. Until it passes that level, should we then...
What is the level? So the level of 45,780 is, if it goes down below that on a sustained basis for a week or two, we're potentially in trouble. When do we know that we're firmly in a bear trend, which is basically a graph that peaks and troughs, but peaks and troughs lower and lower and lower down?
On my chart, it will be 42,000. And
that's
the
a
reason,
long way to go down, isn't it?
Well, it's not. On the top 40 index, it's about 3,500 points. I mean, we gained a lot in the last 2 weeks. But at that 42,000, then the next level is around 39,000. Okay. And I mean, but by then, we're about 8,000 points from the top. I mean, then we're almost in a panic mode. But we're not yet in a bear market until we reach 20%.
The funny thing is, the fundamentalists agree with you. They would say to you, we're not in a bear market, we're in a pullback phase. You would concur we're in a pullback, but you are cautiously watching the graphs to see whether or not the signals indicate another level breach on the way down, which pushes us towards bear territory.
You know what's always interesting is that nobody believes technical analysts
until it happens.
Until levels gets broken. Then suddenly everybody agrees that Vodacom is expensive at this level and Naspers is expensive. And that's why I always say, and you must just go and look at the put structure. And that means if you just pull that from the JSE, you will realize that suddenly everybody is positive above 42,000 and everybody gets negative. And you know what? Who's putting the put structure in place? The fundamentalists.
We must pause there. Thank you so much for coming in. Technical analysis illuminated. I've learned a lot this evening about heads and shoulders, knees and toes, anyway, you know what I'm going with that one. Yeah, the market is in a difficult space. My personal belief is you need to behave like a bear. That's not sell your shares, rather hold on to your shares, keep adding to your portfolios, but hibernate. That's what bears do when times get tough. Thank you to my guests, Moxima Gama, Technical Analyst for the Money Hub, and to Frans, the Independent Technical Analyst. We will try and find more technical ways to make money, but for now, bye-bye.